Hi, this is Scott Hastings with Mortgages by Scott, powered by Homebridge Financial. I help self-employed homeowners qualify for the home that they really want to buy, not the one that their local bank may have told them that they qualify for. The problem, if you're watching this video, you may already know, is that when you're self-employed, you tend to write a lot of things off on your tax returns. And of course, you want to take full advantage of the tax, uh, you know, your tax benefits as a self-employed borrower. Um, so many times I get calls from borrowers. They've been to their local bank or, mortgage broker or whatever, and they've been told, you know, you may not qualify for anything, or if you do, very, very little. So the problem is, or the misconception is, uh, by a lot of self-employed borrowers, is that the money that they make is uh, the money that the a bank or the mortgage underwriter would use for their income. But the problem is, according to mortgage underwriting guidelines, um, the only money that can be used to qualify for a mortgage is, in general, the money that you paid tax on. So if you are self-employed and your business brought in $200,000, but you had $140,000 in legitimate write-offs, then as far as the mortgage goes, you only made $60,000. And that's not going to be enough to buy, what you typically want to buy. Um, so what's the answer? The answer is a bank statement mortgage. So what is that? So in general, a bank statement mortgage, just like it sounds like, totally disregards the tax returns. Don't look at the tax returns at all, and actually are not allowed to look at the tax returns because uh, there is something called the ability to repay rule that came out with the Dodd-Frank Act, after the financial crisis. That's why a lot of sort of stated income loans went away that self-employed people had used prior to that, before the meltdown, mortgage meltdown in 2008 to get a mortgage. What that says is that an underwriter has to prove your ability to repay. So with a bank statement mortgage, what they do is they're going to take your last 12 or 24 months, typically of business bank statements. They're going to add up all the deposits, not the transfers. Transfers aren't going to count. So if you transfer money from your personal account to your business account, for example, that's not going to count. But all of the business deposits, they're going to add those up. They're typically going to use 50% of that because the other 50% will be considered to go towards uh, overhead, to run your business. And 50% of those deposits is going to be your annual income. So, for example, if you have a construction company and you have $500,000 in deposits over the last 12 months, we're going to take $250,000, divide that by 12, and that's going to be your monthly income. So there are, of course, other things to remember on a bank statement mortgage. A CPA or your CPA is going to have to write a letter, stating your ownership percentage of the company. If you're 100% owner, then you're going to use 100% of the deposits. If you're 50% owner, they're just going to use 50% of the deposits. And of course, in that case, after the 50% uh, cut for expenses, then you'd have 25% of the total deposits would be your income. Bank statement mortgages in general are going to have, you're going to have to put a little bit more down. So the minimum down payment is 10%. And the interest rates are going to be a little bit higher, probably 1 to 1.5% higher than on a traditional loan. But anyway, I hope that this answered the question, what is a bank statement mortgage? Again, my name is Scott Hastings with Mortgages by Scott. My contact information is below. And if you have any questions at any time, feel free to call, text. My number is 704-890-7168, or you can go to my website, mortgagesbyscott.com. Thank you.